Dividend investing concentrates attention to ETF and stock charts. Unlike growth investing, the main source of profits will be from dividend payments that are expected to increase over time. These dividend payments will then be reinvested to compound and grow payments even more. The increase in the price of the stock is preferable, but not of primary concern. Fibs will be used to identify situations when it is more desirable to buy more shares of stock. Solid dividend investments often have one or more of the following traits: high dividend yield, high potential for growing dividend yield, consistent record of growing dividend payments, and a consistent record of dividend payments being paid out. These are often large established companies that are leaders in their respective sectors. These sectors are normally the utilities, consumer staples, and financial sectors. Due to a greater portion of growth coming from dividends, the charts of these stocks will often have lower appreciation compared to growth investing stocks. However, that is not to say they increase in price very slowly. The trade-off for consistent growing and/or high dividend yields necessarily means price doesn't rise as fast as growth investments, which almost never pay dividends. In terms of price behavior, these stocks usually fall into trading ranges or have a few major swing points before moving higher. Sharp inclines are less common on these charts. The goal is to purchase more stock for a lower price, to buy more shares for a lower cost, while at the same time capturing the potential for more price appreciation and dividend growth. Consequently, the purchasing price will be much more conservative. As a bare minimum, price should at least drop 3 small fib levels when you consider purchasing a dividend stock. Since their prices often fall into trading ranges and have past swing points to reference, a large and small fib can usually be combined to narrow down the suitable price range for purchasing at. This example demonstrates the contrast of using fibs for dividend investing as opposed to growth investing. With dividend investing, it is much more plausible to wait for larger pullbacks, since dividend stock prices don't climb so sharply. Also, unlike growth investing and shorter-term trading, which mainly profit from increases in price, dividend investors can adapt to falling price better. Price appreciation is only secondary to dividend yield, which is the main source of profit. Dividends are arguably more consistent and reliable contributors to return on investment as opposed to price appreciation alone. Thus, the entry price doesn't have to be spot on at a swing low. A general fib level or zone indicating a desirable discount in price can be adequate. Furthermore, price ranges and time frames covered by fibs are normally very large. It is acceptable to use fibs on a weekly or monthly time frame, in addition to the normal daily time frame. This chart has a combined large and small fib on a monthly chart. A pullback of 3 small fib levels is the minimum threshold to buy. Zones marked in green are especially attractive since they formed from combined large and small fib levels that line up with past reversal areas. Purchasing Verizon stock even at the high price of $33.10 at the minimum 0.5 small fib level threshold would have been a great discount that captured price appreciation and, more importantly, dividend growth. This example has a weekly chart with fibs drawn on a more bullish chart that is starting to peak and reverse back down. Price pulls back less than the previous example, but this is expected on a more bullish chart. Other than that, the same features are seen. More favorable purchasing prices around the areas where fibs combine to form a zone that lines up with past reversal areas. This chart has a fib drawn on a daily chart that has price continuing to plunge after a gap down. The minimum threshold of price dropping 3 small fib levels has been met. However, price shows more potential to drop given the strong gap down and sharp peak, where price had reached all-time highs. Waiting to purchase at lower prices is more sensible. As expected, price continues on a strong downtrend well past the minimum threshold of 3 small fib levels. In fact, the swing low forms well below the small fib and finally reverses around the 0.786 level of the large fib at 66.51. When price is expected to make a large plunge like this, a small fib can be disregarded and focus can be placed at a purchasing price where price drops 3 or more large fib levels. A few years later, when price returns back to previous record highs, a fib is drawn ahead of another expected big drop in price due to several reasons. First, the overall market and Procter & Gamble stock had risen during a prolonged bull market that had shown declining volume, which added to doubts about the longevity of the uptrend. Resistance was expected at the historic highs where price is peaking and reversing. Incidentally, this forms a head and shoulders pattern. The neckline is marked in gray. If the neckline is breached, a large drop is expected. Thus, the minimum fib level, considered as an appropriate discount price, should use a pullback of 3 or more large fib levels and not 3 or more small fib levels. Given the characteristics for a large head and shoulders reversal, a buy target 4 fib levels or more at the 0.618 or 0.786 large fib levels would not be too unreasonable. As expected, price plunges and reverses back up after a drop of more than 3 large fib levels. This allowed for more shares to be bought at lower prices, increasing the potential for more dividend yield and price appreciation. A closer view shows the assumptions for a large drop and reversal were correct. The neckline of the head and shoulders broke with high volume, sending price down to the 0.5 and 0.618 large fib levels, where there were minor stalls and a bounce back up. However, the strong bearish force continued to break all the way down to the large 0.786 fib level on more high bearish volume and even a large gap down in price during late April and early May. The reversal back up did have some volume spikes, but overall volume was at normal levels. This is common price behavior in this type of scenario because price has fallen for so long and on such high bearish volume. A modest bounce back up can easily be achieved on normal bullish volume because the chart is very oversold and bearish volume has been well expended. Here is another example of characteristics seen on charts of dividend investments. There are plenty of trading ranges and past reversals to reference. The minimum pullback of 3 small fib levels is a low threshold. As seen here, price did stall at that level for a long time in a trading range. Just a little more patience was able to catch far lower prices in the zone formed by the 0.786 small fib level and 0.618 large fib level, which lined up with past bullish reversals in 2014.